Hey, good morning once again, options traders. Well, in the last video, I talked about the misperception that a lot of traders have with the time decay graph, especially when you start looking at shorter dated options. And I made a casual mention that this is one of the traps that short-term traders fall into, especially those who sell zero DTE options. And somebody, of course, has emailed and said, well, could you talk a little bit more about what those dangers are? So that's what we're going to do here. It's a very good topic because zero DTE options can be really enticing. Lots of people like to go out there and sell these, usually the naked puts, but to sell really any short-term option because it just looks like free money. They're going to expire in a matter of hours. They sell them out of the money, and it just looks like it's an easy way to make consistent profits. But there are some really big dangers that you have to be aware of. So let's go find out what they are. And as always, before we do, please be sure to click like and subscribe. It does go a long way into promoting the channel and is greatly appreciated. So let's start with a quick definition. What are zero DTE options? Well, it's just a shorthand notation that means options with 0 days to expiration, which is a little bit of a misnomer. It doesn't mean that they have no time remaining. It means that they have one trading day. There are no remaining days after today. So how did these come about? Well, there's been a whole series of releases from the SIBO, the Chicago Board Options Exchange. Starting in 2005, the SIBO introduced weekly options. So these were options that, as the name implies, expired in a week. So the first ones were on Friday. They came out on a Thursday and expired the following Friday. So in February of 2016, the SIBO introduced Wednesday weeklies. Same idea, but they came out on Tuesday and expired the following Wednesday. And then in July of 2016, Monday weeklies were added. So at this point, we had Monday, Wednesday, and Friday weeklies that were traded. Well, in May of 2022, the SIBO introduced daily options. Now, sometimes people think that these are options that are listed every single day for a lifespan of one day. And you could certainly look at it that way, but that's not really what's happening. Instead, what happened is that in May of 2022, Tuesday and Thursday weeklies were introduced. And that, by default, created daily expirations. Because if you have a weekly option for every single day of the week, then by definition, you're going to have one that will be expiring every single day of the week. And so they just gave them a name of zero DTE options. Now, whether they just added Tuesday and Thursday weeklies and we ended up with zero DTEs, or maybe they did want to create daily options and they thought, well, we could do that by adding Tuesday and Thursday weeklies. But they're really just weekly expirations, and because we have an expiration every single day, then we have options that expire every single day. So let's find out a little bit more about these zero DTE options. The first thing to understand is that they are no different from any other option. They've got the same contract specifications. They're identical to all of the options that you're used to trading. Now, the zero DTE volume has nearly doubled to 44% of the 10-day average daily volume. So they are extremely popular. Now, the S&P 500 ETF, that is the SPY, ticker SPY, has also seen a surge in trading of zero DTE contracts, often accounting for 50% of the volume. That's absolutely massive. Now, also, the daily notional value of trading in zero DTE options has exploded to, get this, about $1 trillion, and that's according to JP Morgan. So again, they are quite popular. Well, these zero DTEs are listed on most highly liquid stocks, ETFs, and indexes. Now again, technically, all options have zero DTE options. Even if you go back to 1973 when the SIBO first listed monthly contracts, well, 30-day options will have zero DTEs once each month. So as long as you have an expiration date, at some point in the cycle, all listed options will be a zero DTE option. So remember that weekly options will have zero DTEs once each week. So again, technically speaking, all listed optionable stocks and indexes do have zero DTEs. They're probably just not going to be every single trading day. So to find those, we usually have to look to the indexes. So which indexes have zero DTE options? Well, the S&P 500 index, ticker SPX, the Spider S&P 500 ETF, the SPY that I just spoke about, also has zero DTEs. Now also the mini SPX index, ticker XSP, also has zero DTEs listed. That's an index that is 1/10 the size of the standard SPX contract. Now also the XSP is settled in cash rather than in shares like the SPY. And when you have an index that is settled in shares, that can cause another potential problem, which we'll talk about here shortly. There's also the NASDAQ 100 Index, NDX, and then there's Invesco NASDAQ 100 Trust, or the QQQs. Now, out of all of these, it's probably safe to say that the SPX is the most popular. And part of the reason is the ability to trade daily. It's also the most liquid contract, so you have very narrow bid-ask spreads, super important for doing daily trading. But probably most important is that the SPX options cash settle. And so you're not going to get assigned if they expire in the money. So remember that if an option expires at least 1 penny in the money, it's going to go through auto exercise. And if you're the buyer, you can call the broker and say, hey, I don't want to exercise this option, even though it's eligible for auto exercise. And you can do that because you are the long position. But if you're the short position, and remember that's what a lot of traders are doing with these zero DTEs, you have an obligation. You can't just call and block the assignment. You would have to instead go into the market and close that contract out. But just in the event that you happen to forget or happen to miss it somehow, it's going to settle in cash. You're not going to end up with a surprise short position on Monday morning and end up with some type of a big gap risk. So that's another benefit of the SPX. They settle in cash. The value of the cash isn't going to change should you go through an auto exercise. Now, in contrast, the SPY options are physically settled. That's true of all of your ETFs. So if a SPY contract goes in the money and you forget about it, they're going to settle in shares. And again, that can add another layer of risk. So again, for all of these reasons, the SPX is probably the most popular. Now that we've covered that, who trades zero DTEs? Well, they're extremely popular among option sellers. And of course, they're shorting these options, and so these are commonly sold and then bought back for a lower price at some time during the trading day. And we all know that the zero DTE options have high amounts of theta or premium decay. So again, that's the big attraction. I can sell this option that's a few pennies out of the money. I still might be able to get 25 or 30 cents for it. I'm going to sell it 10 or 20 times and put $200 or $300, $600 in my pocket. And yeah, a lot of times that's going to work out perfectly. But there's a very big overlooked risk in doing this. So again, yes, these zero DTEs are very popular with sellers, but they're also popular with buyers. And what you're going to find out here shortly is that all of the benefits to the buyer are by default risks to the seller. So if you understand what the benefits are for the buyers, you will immediately see why these can be so risky to sell. So what are the buyer benefits of these zero DTEs? Well, first and foremost, they have extremely high gamma. Now remember, gamma is the highest for the at-the-money contract, and that's a lot of times what people are selling, or maybe slightly out of the money, but still pretty close to your at-the-money contract. And as you get closer to expiration, those gammas can go to infinity. They just go off the charts. And so remember what gamma is. It just means it's a rapid acceleration of your deltas. So you might sell this out of the money put and say, it's only a 35 or 40 delta. But if that stock price ticks down just a little bit, suddenly it can be a delta 1 or delta -1 in the case of a put. but it can go virtually deep in the money with just a very small move in the underlying stock. So that's really the big risk, that options can move from a low delta to a delta of 1 for the calls, or again, -1 for the puts, very quickly. That's the risk of high gamma. Now, of course, that's a huge benefit for the buyer because you might be able to buy this option again for 30 or 40 cents, 50 cents, and the option barely goes into the money. Maybe the stock runs a little bit, and suddenly that thing is 2 or 3 points in the money. So you paid maybe 15, 20 cents for it, and you can now sell it for $3. So that's a huge benefit for the buyers, this extremely high gamma. And that is really the hidden risk that so many option sellers miss. So always remember, the benefits for the buyers are risks to the sellers. And that's because the sellers are simply on the opposite side of the trade. So let's go take a look at a couple of graphs. Here is a gamma graph for a 60-day option at the money. So it's a 100 strike, and that's the peak of this curve. Looks like a little bell curve. But notice how flat it is. Very flat and wide. And what that shows is that if the stock price moves down a little bit, maybe down here to 98 or 97, or even up here to 101 or 102, 103, there's not a big difference. That curve is fairly flat through there. And it's also very low. It's only standing up here at about 0.05. And then it slowly starts to fall off as you move either further in or out of the money. But take a look at what happens if we look at everything else the same. Same at the money strike, but with 0 days to expiration. Now your graph moves from the black to the red. So now you can see we've gone from maybe 0.05 to 0.5. And that's only going to accelerate as the hours tick by. So this could be into the hundreds, thousands, tens of thousands. Now again, that doesn't necessarily mean that your deltas are going to get propelled to tens of thousands. What it means is that it might take an ever so slight move in the stock price to make that option go to delta 1. That's really what it means. And that's what's happening when you get this extremely high gamma. So again, that's a benefit to the buyer and an enormous risk to the seller. Let's take a look at the delta side of that. If we have 60 days until expiration, we get, looks like a lazy S. It's just showing us our deltas. So if we have an at the money call, the graph tells us that our delta is right there, about 0.5, which everybody knows your at the money option has a delta of about a half. But as the stock price starts moving up, this is for calls, you can see that the delta is slowly starting to climb. And if the stock happens to get way up here, pushing that $100 call deep in the money, now we're getting closer to 1. And eventually we will max out at 1. But it's a fairly lazy S shape with 60 days until expiration. Now let's take everything else the same, but just make it a 0 DTE. So our curve goes from in black to red. And look at that. This is an at the money option. And so right now, yep, the delta is the same right there at a half. You can see where the red and black lines intersect. But if this stock moves up just a little bit, didn't make a huge difference on the black curve, but shoots us pretty much straight up to delta 1. And so again, this is the big risk of selling these 0 DTE options. It looks like free money, but the thing that traders miss is the extremely high gamma, which is really the acceleration of the deltas. Now there's another big potential risk. This is a little bit more theoretical, but certainly could happen, and that is a potential systemic danger. Now a systemic danger is one where you have a market where you've got a lot of things that are linked together so that if one falls, all of the dominoes go. So you hear this a lot about in banking, about systemic risks in banking. You have one bank that fails and suddenly 10 or 20 theoretically could also go under because they're all tied together. Well, that could also happen with 0 DTEs, and here's how. Let's say that our stock is trading at 100 and you go out and sell the 98 put. So it's 2 points out of the money, you sell it for 30 cents. Looks like a pretty safe trade. And maybe you sell this thing 10 or 20 times to actually make this maybe $600. But then during the day, let's say that the stock actually falls towards this strike. Now remember, it doesn't even have to go in the money, but it has to start to threaten it. And what's going to happen is that the value of this put is going to go up. And now in response, as everybody is out rushing to buy these things back, right? Because these guys are terrified. They sold them for 30 cents. They're now trading for 75 cents or a buck, and people are rushing out to close these positions. So in order to do that, the market makers have to create the puts, or at least that's one thing that could happen. And the way that they do this is synthetically, is that they will sell the shares, short stock, and buy calls. That's a synthetic long put. And then if they sell the put, that completes the reversal for them, which really gives them a locked trade. But the idea to see here is that the market makers are selling shares. And so if they go on a rampage of selling shares to meet these orders, what could happen? That can push the stock price further down, which now makes the price of the put go even higher, which makes the short traders rush out even harder to buy these things back, which causes the market makers to sell shares even faster and more aggressively. And you can just see it ends up being a positive feedback loop. So even though you might have the best intentions of saying, oh, I'm not really taking that much risk because if I see it get to a certain level, I'll just close it. Well, you might not have that opportunity. Also, as the volatility picks up, those bid-ask spreads are going to get really wide really quick. And so while you're sitting here scratching your head going, what just happened, and taking a few seconds to analyze it, this whole thing could really implode. So the main thing is to understand that, sure, zero DTE options are a tool, and they can be a fabulous tool for the right situations. The main thing I want you to get from this video is that they are not a way to get free money from the markets. You are picking up nickels in front of bulldozers, and hopefully this video shows you why. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.